So continuing our lessons on checking accounts. Lesson 5.3 talks about a dishonored check. What a dishonored check is a check that the bank won't pay. There's several reasons why they won't pay. The main reason is there's not enough money in the bank account to cover the check. And so that's a non-sufficient funds check. That is the most common. Somebody writes you a check for $200, you go to cash it, there's not $200 in their bank account. And so a non-sufficient funds check is also known as NSF check. So what happens when you as the business get a check? Basically a bad check, if you've ever heard of people saying that they write bad checks. That's what a dishonored check is. So when someone gives you a check, you deposit it into your bank account, and then it goes to the person's bank that they wrote it on, and there's not enough money in there, and they return that check. That's kind of what's happening here. And in today's world of electronic banking, this doesn't happen near as much because they can run those through and see that there is money in the account, and then it holds that money to cover it. But this is kind of basically old school a little bit with the dishonored check. So somebody gives you a check, you deposit it in your bank account, and then your bank notifies you that it was a bad check and that money is not there. So you have to basically take it back out of your bank account. So you're going to go first to your check stub, because we always fill those out first. You're going to write dishonored check on there, and then you're going to write the amount that the check was for, and then you're going to subtract it out of your subtotal to take it back out of your money. Now, this is your records, remember. This is just your check stub that tells you how much money you have in there. So, like everything else, we have to do a journal entry for that, because just recording it on the bank stub does not take it out of our bank account. We have to go back into our account so that our ledgers, our cash account in our general ledger, shows the correct amount. So we have the transaction, received the notice from the bank of a dishonored check from Valley Landscaping for $185 plus a $40 fee. So here's what happens. Valley Landscaping paid us $185, but that check was not good, and the bank charged us $40 for the processing fees for that. Well, we're not going to eat that $40. We're going to make Valley Landscaping pay us that $40. So the transaction then is we're going to put that back into Valley Landscaping's accounts receivable, which is an asset. We need to put it back in there to show that they owe us that money, and we're going to take it out of cash. Because what happened when they paid us was we debited cash and credited accounts receivable. Now we're just basically putting it back in there with the additional $40 bank fee added back into it. That source document is going to be a memo, because that's what we got. We just got notice from the bank, so we create a memo for it. So the next part is talking about journalizing electronic funds transfer. So we're coming into current times here a little bit. An electronic funds transfer is basically what it says. It's an electronic payment or deposit onto your account. It's a computerized cash payment. Could be direct deposits, could be payments, direct payments, a wire transfer, an electronic bill payment, could be using your debit card, lots of different reasons that would be. These are what you are probably used to doing when you run a debit card. So the way we journalize that, because if you think about it, you run a debit card, it comes right out of your bank account. So it's going to work just like writing a check would, except for the source document. So we paid cash from account to this company using EFT. Basically, we transferred the money to them or ran a debit card. And so what we owe them is going to go down, and our cash is also going to go down. So accounts payable is a liability, has a normal credit balance. We have to show that we paid them, so the balance goes down with a debit. just like a payment on account with a check, except the source document's different because you're doing it electronically. So not really a brand new transaction, just the way the payment's going, not a check being done electronically. And then a debit card, real quick. Let's talk about debit cards because that's what you guys are probably familiar with. Some of you have debit cards, some of you don't, but you probably will in the near future. And debit card is basically a plastic card that runs just like a credit card, except it comes directly out of your bank account immediately. And a credit card does not. So the main differences between the two is a debit card is tied directly to your checking account, can be used anywhere credit cards are accepted. You typically have to have a PIN number, a 4-digit PIN number that you choose so that when you run it, it asks for your PIN, put it in there, and then it goes through. These are good for daily use if you're going to stay in budget, but you got to remember to write those things down. You got to know what you have in your bank account. And if you just start swiping that debit card, sometimes you tend to spend more money than you really have. A credit card then is different because it doesn't come directly out of your bank account. It builds up a balance, and typically they're going to charge you interest on that balance if you don't pay it all off in 30 days. Credit cards can get you in a lot of trouble if you don't pay those off because that interest can build up and build up. Sometimes that interest is 25, 30% interest, and that's huge. But sometimes, depending on what you're doing, like if you're going to book airplane tickets or a hotel room or car rentals or things like that, you have to use a credit card. You do not want to use a debit card to do that. A couple of reasons are that sometimes if you use your debit card, the place where you rent it, let's say you do a hotel and that like for 2 or 3 nights, and so the bill's going to be like $300. The hotel can actually freeze your account, your checking account, for double what you owe them just to make sure that that money's there when the transaction completes. And that can put a real damper on your ability to spend your money. So just highly, highly suggest don't use a debit card if you're ever going to be doing those kinds of reservations. Use a credit card, but pay it off every month so that you don't build that interest up. So when you journalize that, purchase supplies for $75 using debit card. It's just like purchasing supplies for cash because that debit card comes right out of your bank account. So supplies goes up, cash goes down. Only thing different is that source document is a memo and not a check.